Hello, this is James. If you, like millions of Americans, have been doing the right thing for years, paying premiums for a long-term care LTC policy, you need to immediately stop what you are doing. You pay those premiums to avoid bankruptcy if you ever need care. You pay to avoid being a burden on your children. But I must tell you this, your policy might be worthless. I am holding the very letter that has gone out to thousands of seniors. A notice of a 200% premium hike, or even worse, a notice that your actual benefits have been slashed. We are going to find out why the insurance giants you trusted are suddenly stealing your money and your peace of mind. The core problem with LTC is that it is not like traditional insurance. Starting in the 90s, when these policies were first sold, the insurers made two catastrophic errors that you are now paying for. Catastrophe number one, wrong life expectancy calculation. People are living longer than expected, much longer. The average duration of LTC usage has increased from 2.5 years to over 5 years. This simply drained their reserves faster than they planned. Catastrophe number two, low investment returns. Insurers invested your premiums mainly in bonds which yielded extremely low interest rates, especially after 2008. The money they collected simply was not enough to cover the increased costs of care and the extended lifespans. And now, these giants come to you and say, pay double the premium, or your daily benefit will be cut from 300 to 150 you are left with no good choice. If you choose not to pay the 200% increase, your policy simply lapses, and you lose every dollar you paid over the last 20 years. But there is an even worse trap. The extremely strict policy activation requirements to receive benefits. You must meet criteria called the ADLs, activities of daily living. Payouts only begin if you cannot perform a minimum of 2 out of 6 basic activities, such as bathing, dressing, transferring, or eating. For example, you might be suffering from Alzheimer's or severe dementia, meaning you absolutely cannot be left alone, cognitive impairment. But physically, you can still dress yourself and feed yourself. The insurance company can deny your claim because you technically have not met the threshold of 2 physical AD. What if your policy has a limit called cash indemnity? The insurer may pay you $200 per day, even if the actual cost of your nursing home care is $350 per day. You are responsible for the $150 difference, which quickly wipes out your retirement savings. So, what should you do if you already pay for LTC or are planning to buy coverage? 1. Immediately review your existing policy. Find out if you have non-cancelable protection. This is rare. And what your basis of claim payment is it indemnity, reimbursement, or per diem? Demand clarity on what triggers a payout. 2. The hybrid policy. This is the best modern solution. It essentially bundles life insurance with LTC. If you do not use the long-term care benefit, your children receive a life insurance payout. If you do use it, the benefit pays for LTC. Your money never vanishes. 3. Medicaid. This is a government program that covers long-term care. However, to qualify, you must essentially be destitute. You will have to spend down nearly all your assets. This is absolutely not your plan A, but it is the final safety net for many seniors. Do not let these insurance giants take away your financial security. Your children and your retirement depend on how well you plan right now. Make this call today. Contact your financial advisor or insurance broker and demand a review of your current LTC policy. Demand specific answers about protection against future rate hikes. If this video helped you avoid a financial disaster, please subscribe to the channel. We expose the traps that threaten your retirement every single week. Next time, We will talk about the ichimang the IRS can quietly steal from you if you do not do one simple thing with your 401k.